Well, good day, everybody. Welcome back. Thanks for joining us. And Alex Jamieson from AJFinancialPlanning is with us as usual. Good day, mate.
Hey, Greg. Great to be here.
Yes, I'm enjoying the D's at the moment, but let's not go there. Vilfredo Pareto is an Italian name, and it was from the early 20th century. Now, he discovered and published what he called the Pareto Principle of unequal distribution. Can you tell us a bit about that and its effect on life?
You know, we keep learning from history. Every time we catch up, Greg, we continue to sort of have these conversations about what's happened in the past. And, you know, these forward-looking people in the early 1900s, you know, real thought leaders, it's really fascinating. As you mentioned, 1900, very different place to today. But in a lot of cases, there's aspects of life that we can really take some great knowledge cues from him. So as you mentioned, he was Italian, and he really looked into this academic study around, he made this observation and really delved into it in quite a deep sort of manner. And what he found is that, you know, 20% of the population base in Italy own something close to 80% of the land holding. And you could imagine the extraordinary wealth that was really tied to that population base. And a lot of these older sort of cultures, you know, the generation of land holdings being passed to one another through those sort of bloodlines. It's an interesting sort of, study, but it has applications, as you mentioned, to really some much wider sort of areas within the investment markets and life in general too.
Okay. We go forward 40 years. There's a guy called Joseph Juran. He's a business theorist. He discovered Pareto's work, and he found there was an application for business as well.
Yeah, so he was in the area of management consulting. I guess the application was in this area of management consulting. This is where we really see this principle being used historically and into the future. A lot of business owners that I chat to, they talk about this principle quite often, we see. I need to sort of put it out there socially. This is probably not the most sort of socially accepted sort of policy. And so basically what he discovered, building on further with the work, was for a lot of businesses, 80% of their revenue came from 20% of their customer base. And so that was a tremendous sort of finding, because I guess it really allowed these businesses to, possibly really focus with precision into that 20% sort of grouping of customers. And then certainly, removing some of the noise possibly within their business and simplifying it too. And so, yeah, this extrapolated right through society and was known today as the 80-20 principle that we sort of hear thrown around the bandwagon in these management consulting sort of circles.
So how does that become relevant to investing?
You know, it's to some degree, we sort of think of it on a couple of layers. So first and foremost, we think it from a competition perspective, and we find the principle has some relevances there too, where, you know, there are a number of business participants, and the leaders in that marketplace tends to have the lion's share of the revenue. So in terms of when we're thinking about a universe of companies, it allows us really to rapidly consolidate into a small number of companies that have it. From a founder perspective as well, you know, as you said, it's an unequal distribution, which means that it's not fair. And so what you tend to find as well is these founders are producing returns or company performance that's way outside the normal sort of group of businesses. And so, you know, in society, we may look at companies like, you know, founders like the Google guys or the Elon Musks or the Warren Buffetts, the Berkshire Hathaways, you know, founders that are not normal in the cohort. And then really you can drive down to, even from an employee perspective, again, it's unequal. Socially, it's not acceptable really to make these statements, but some of the studies that have been done are sort of saying, look, you know, 20% of the employee base is also representing 80% of the output within businesses as well. And where are they wanting to be attracted to organizations that tend to be also equally high performing as well. And so, from a fundamental overlay, which is not so much the numbers, it's looking at management quality and aspects of the business operation, they can really start to give you a more granular sort of picture.
So is it fair to say that this is possibly a universal rule that keeps popping up in different areas?
It's crazy how often we see it pop up, and it's sort of like when you get shown a new car and then you see it when you're out driving around, it pops up all the time. It's one of those weird sort of phenomena. You sort of see something you haven't sort of observed before. We only sort of have to look at basic things like the tax base in Australia as well. When we look at the population base that's paying the majority of taxes in terms of personal income tax, the rule does somewhat start to fit into that area as well. We also look at aspects of life. I mentioned employee bases and manufacturing as well is a really interesting sort of area where that tends to crop up. And like with any of these universal laws, there's always examples where it doesn't work, but it's something that's an interesting observation. And for us, it's a case of, okay, well, this is interesting. How do we utilize it as a tool? And I guess keep our eyes wide open for it, which is the other important part as well too.
Well, this is budget month. So with regard to the markets, where are we placed? Where do you think we're going to be placed?
Yeah, certainly we're seeing last year the world really shun the traditional area of the market, your traditional sort of businesses, and was focused heavily on new innovative ideas and technology, and really caught up in that interesting sort of space because of what COVID had largely have done. And during that period of time, we were fortunate we could see that great traditional businesses were just being disregarded, and some of the valuations were really attractive and had the ability to pick up some opportunities within that. The market's certainly now at the moment caught up to this idea, and we're seeing this rotation out of future forward-looking sort of organizations into more traditional sort of businesses. I sort of feel to some degree it's more of a short-term trend because the traditional area of the market still does have tremendous headwinds. And, years ago we spoke about that disruption piece around the business and their ability to last multiple of decades, and the unlikely sort of probabilities that they start to run into that in those more mature sort of areas. But certainly in the short term, that's where a lot of money is flowing. We also run into some tax selling, which is around June traditionally. And certainly our sort of level of expectation is a softening in the market from June through till about October, which normally happens most years. It's not unexpected. I guess on the flip side, we sort of look, the governments globally are spending tremendous amounts of money on stimulus. And historically, what we're seeing so far is that has led to an appreciation of growth-based assets being property or shares. And we expect that to continue for some time, that massive tailwind of stimulus spending. So, from our side of things, it's an interesting marketplace at the moment.
And it's something that you're very positive about?
Yeah, very much so. We feel, certainly what's transpired to date in terms of our roadmap, are we on the road or sitting in a ditch? We feel very much with comfort that we're on the roadmap. And certainly in terms of the forward outlooks, there's nothing on the future horizon that's causing us any great deal of trouble.
Well, what a wonderful place to end this session. Thanks for joining us. We've talked about Vilfredo Pareto and the unequal distribution. We talked about, what was his name, Joseph Juran. And I just want to add that you said that was in the 1940s. He lived till 2008. He was 103 years of age. But get this, he was married to his wife Sadie for 82 years. Now that's a long-term investment. And whether unequal or equal distribution, I've got no idea. Catch you next time. The advice provided on this program is general advice only. It has been prepared without taking into account your objectives, financial situation, or needs. So before acting on this advice, you should consider the appropriateness of the advice and consult a finance professional. If any products are detailed on this program, you should obtain a product disclosure statement relating to the products and consider its contents before making any decisions. Where quoted, past performance is not indicative of future performance.